Welcome to Ask an Advisor, where we here at Team Clark talk about all things investing.
All things investing.
Saving for your retirement. And today, two topics we like to talk about, but you've got some specific spins on those topics. One is Clark loves to talk about the Roth IRA. He calls himself the man from Roth. Roth conversions, we get questions about those all the time.
Oh, boy.
And you're going to talk about taxes and Roth conversions.
Well, I'm
right?
going to talk about an article that was just in the Wall Street Journal from some professor who is saying that you should do your Roth conversion all at once, and they use a $1 million example, and it's insanity. I cannot believe this was published.
Okay.
I had to read it 5 times to even see how it was possible what they're saying.
Okay.
And so that's our first topic.
That's our first topic. And then
it's the $400,000 tax bomb is what it's about.
Okay. And then the second thing you're going to talk about later after we go to some of your questions for Wes is leaving your old 401ks behind. The advice was always, leave it in there because you might have a better deal with your old employer, but there's actually some people are leaving money behind and it's a real problem, right?
Forgetting at $28 billion in uninvested, floundering 401k money.
That sounds really bad.
Floundering.
And if you have a question for Wes, you can go to clark.com/ask and let us know that you would like Wes to answer your question.
Can we start with this?
Yes.
I call this the $400,000 tax bomb, and that's underestimating it.
Wow.
And why you should not convert your entire IRA to a Roth all at once, which is totally contrary to the story that was an op-ed in the Wall Street Journal. So it's not the Wall Street Journal's fault. But this story stopped me in my tracks, which is rare for a personal finance story because I've read the same stories over and over and over again for years and years and years. And I'm actually not even going to mention it's a finance professor from a university who did this. So he's a finance professor, not a financial advisor.
Okay.
And I think that may be part of the issue here. It's the academic view of a Roth conversion versus the real world part of it. And it argued that retirees should convert their traditional IRAs to Roths all at once, 100% one big move.
Okay.
So according to their modeling from this university, the approach supposedly beats converting gradually over time. So on paper, maybe it sounds great, and I thought, wait a minute, let's see what their assumptions are. But I can't. This kind of advice to me is scary because imagine somebody reads this article. They have $1 million Roth, which, by the way, that's the example they use, a $1 million Roth conversion. They say just convert it all at once. I'm just worried that people are going to go read this. Oh, it's in the Wall Street Journal. And then they're going to be creating what is an absolute tax bomb, tsunami, whatever you want to call it. It is such a massive tax bill that I cannot believe somebody would write to do this. But here's the line that I can't believe they put into writing. If a big tax bill is no problem.
When is that ever the case?
If a big tax bill is no problem? To what American would ever say, oh, no problem?
Yeah.
So so on the surface, I thought this is
And obviously a big
lunacy.
tax bill would be a problem if you're trying to convert to a Roth. You're trying to avoid future taxes by doing a conversion. So you care about taxes by nature if you're trying to convert to a Roth.
Correct. So we know, look, if you're going to convert to a Roth, we know moving money from an IRA into a Roth, it's going to create a tax bill. There's no question about this. But let's get into this craziness. And I had our team recreate this. I said, guys, because the article doesn't give you the entire model. So you kind of have to back into what they're saying. The model that they're using in the article assumes a flat rate of 10, 20, or 30%, which applies equally to the Roth conversion and to the future RMDs. Mm-hmm. One huge problem right there. Because if you're converting a big number, your tax bracket, we have marginal tax rates. They're like buckets. Exactly. One gets filled, and the next one gets filled, and the next one gets filled, and it goes all the way up to 37%. Plus state tax, which can go beyond even 10%. So you could, on a big conversion, you could easily be in the 37 federal and another 5 to 10%, depending on what state you're in. You could be at 47% tax bill to do a conversion. And to some extent, it doesn't look like they modeled that. They assume the retiree has the cash to pay the bill. This huge, well, as long as you just have the money to do it. And then they use a short window. They just use a 10-year comparison, which heavily favors the one-time conversion. They ignore, I think, reality, which is the practical part of what we all have to actually consider: liquidity needs, Medicare brackets, deductions, phase outs, and then the real world cash flow. Hey, you gotta, if you convert this IRA to a Roth, you've got to take money from somewhere else to pay the tax bill. They first say that a one-time conversion makes sense in most situations, regardless of the tax bill.
Okay.
But then at the end of the article, they say it's only optimal if a big tax bill is no problem. This is absolute lunacy. Mm-hmm. And you're hearing it here first on the Clark Howard Show, Ask an Advisor. All right, so what else do? They conclude that a one-time conversion, they use a $1 million portfolio, earning 6% annually, tested across marginal rates of 10, 20, and 30, not scaling, but converting at 20%, converting at 30. It seems like that's what they're doing here. And then they compare these three strategies: leaving the money in a traditional IRA, and having to take RMDs, converting gradually over time, and then converting it all at once. If a big tax bill is no problem, then they say it could make sense for you. But let's just do the simple math here without having to recreate it, which our team did, and essentially just says that they're not looking at the change in tax rates that would occur on a $1 million conversion. You would be immediately in the 37 tax bracket, most likely. You would be, depending on other deductions. So you've got to be careful about everyone's tax situation can be very different. But for most folks, you convert $1 million, $1 million, you have $1 million in income. Boom. So that's 37%. Another 5 to 10 for state. Your tax bill could be $400 to $500 grand to do that conversion.
And, we're assuming people have that laying around.
Assuming remember, if the tax bill is no big deal to you, not to mention pushing Medicare premiums higher, so IRMA surcharges, not to mention the taxation of your Social Security benefits, not to mention elimination of deductions and credits and all the other things you'd get, because you're not going to get them because you're in this super high tax bracket. There was a comment in this. I'm going to try to find this. Here's one of the Wall Street Journal readers' comment. Are you going to pay 37% in taxes today so you don't have to pay 10% in the future? It boggles my mind that they publish this, because it makes it seem like, oh yeah, I'm a professor of financial planning and I did the model and it says that it's better just to convert all at once. Be really careful here. The Roth conversions and I've had this conversation with almost every family I work with. It should be done over time. Mm-hmm. You fill up one tax bucket, you make sure you don't get to the next tax bracket, or you know what the next tax bracket might be. That to me is the only realistic, practical way to do Roth conversions. There's always going to be an outlying case in either direction where maybe you could make the case to do this all at once, but for the vast majority of folks, be really careful reading that article and just creating an absolute tax tsunami for yourself.
All right. You ready for some questions?
Yeah.
This one came in from Rich in Nevada. He says, Dear Wes, my wife and I have been saving the past 17 years in a 529 for one of our daughters, and it's grown to a value of $115,000. We currently take distributions from the account to pay for qualified K through 12 educational expenses with homeschool tuition. Our daughter has expressed interest in earning an associate's degree to become a paralegal. Based on expected college expenses, we believe there will be unused 529 funds, and we would like to roll over $35,000 to her Roth IRA. With this goal in mind, we have the following questions. One, since our daughter's Roth IRA is currently a custodial account, do we need to wait until she turns 18 to start the rollover process? Two, one of the rules per the Secure 2.0 Act of 2022 states the Roth IRA contribution is subject to the limit for the taxable year applicable to the designated beneficiary for all individual retirement plans maintained for the benefit of the designated beneficiary. Since the current annual IRA limit is $7,000, should we plan to make annual rollovers up to the maximum amount for 5 years? Three, finally, how should we expect the rollovers to be documented? Will they not be listed on the IRS Form 1099-Q since the transactions are rollovers instead of distributions? Big thanks to you, Christa and Clark, and everyone at Team Clark for helping us increase our confidence through financial education.
Rich in Nevada.
Thank you for listening, Rich.
Thank you for listening, Rich. Number one, custodial, she's only 17. You do not have to wait until she's 18 to start doing this. So that's number one. Number two, really your question was about the earned income. And by the way, 2026, the IRA limit's going up to
7,500, right? Yeah.
Right. So yes, it is subject to how much she earns in a given year. So if she makes $5,000 in income, that would be the most you could convert. If she makes $10,000 in a year, you could convert up to the maximum of the 7,500. But you do have that right. You want to do you want as much earned income as she has. Hopefully you get to the $7,500 limit, and then you would convert that over the course of, call it 5 years. Take 4 to 5 years, and you should be able to do the full 35K. The last part was reporting. The conversion, I don't know the exact form you would get, but I would think any brokerage firm, Schwab, Fidelity, Vanguard, you're going to get you'll get a distribution form that'll code this as a rollover, and that way you're not having to pay taxes on this. So I don't know the exact form, Rich from Nevada, but you would just ask your financial institution to make sure it's coded properly so that you're not paying taxes on it. And I think that should be no problem either.
Awesome. Dan in Missouri says, Wes, you've talked at length about the 4% rule, but what if we want to stop working years before we take our Social Security? Any formula for taking a higher percentage distribution before Social Security and reducing to lower than 4% between 65 and 70 when we take our Social Security benefits? Love the show.
Love your question, Dan from Missouri. The great thing about the 4% rule, and that's how people refer to it, is that when you hear the word rule, you hear etched in stone as though it's something that is extraordinarily by the book. And that's kind of the opposite of the 4% rule. The 4% rule is a rule of thumb. And it's important to know that, because that means that it is not a straight line calculation. It is a destination, meaning we want to settle into that 4 to 4.5% range over time. So absolutely, you can, and this happens all the time. There's usually a gap, particularly if you're an early retiree, you're retiring sooner. Maybe you don't want to take your Social Security until 67, and you're retired at 64. So you have a 3-year gap, and you need a little extra money from your portfolio because Social hasn't kicked in. But when Social kicks in, you will be able to lower your withdrawals. So this happens all the time. And for you to be able to go to 5, even 6, even a little higher than that for 2 to 3 years, usually it's no problem whatsoever. And then you get to the point where Social kicks in, your spending need, the withdrawal need goes down, and then you can adjust your withdrawals back to 4% or maybe even lower. And I've modeled that out for folks many, many times. Dan, this is a good place to do a cash flow plan or a formal cash flow analysis or retirement plan, because you can just model in, hey, what if I take 6.5% for 3 years? What does that do to my balances? And then I adjust down to 4 or 3.5. I know that can work. Now, you don't want to do this you don't want to take 6% for 10 years and really materially have your balances drop. And you also, one other caution, make sure that when you're in that period of time when your withdrawal rate's a little high, you've got some real balance. The last thing you want to have happen is you're having really high withdrawal rates and you have a 100% stock portfolio and the market goes down. That's called sequence of return risk, is that we're in a bear market and you're pulling out more than you would like to relative to the 4% rule of thumb. So just make sure you have a really good balance if you're going to have to do that.
All right. Debbie in North Carolina says, Wes had a caller that asked about canceling his life insurance, and Wes said not to do it yet. When is the time to cancel your life insurance? Wes also told us several years ago to not cancel our life insurance and take out another 10-year term life policy. Please explain when it's okay to cancel. Thanks.
Deb, I wonder if she's listening to my radio show.
Probably
radio.
Or your...
or Retired
Podcasts,
Sooner podcasts. Yeah. So, Deb, the simple answer is when you don't need it anymore. That's when you cancel your life insurance. Or it becomes...
And when don't you need it anymore? What would the reason
Or
be?
when it becomes financially too detrimental to your current situation. And that can happen as well if there are policies that have rates that go up every year. And that can make it to the point where you just can't afford it, and the benefit of the life insurance is you can't pay for it. So, Deb, when do you not need it anymore is the question, and it's somewhat subjective, but there's some really really important some really important check marks to look for. One, the life insurance typically is for either the kids or the spouse. So if the kids are grown up and they're out of the house and they don't need to, they don't need to rely on you financially anymore to pay for big bills like college, that's one where life insurance becomes less important because you pass away, you can't work, you can't pay for your kids' college. So that's a milestone that's an important milestone. The second one is that when you and your husband or your spouse or you personally have enough saved and enough income to know that the life insurance would be more money on top if something happened, but you don't really need it anymore to fund your spending needs. So those are scenarios. One, the kids are okay. They're financially independent. And two, you've created your own independence and you no longer need the insurance. The other thought though is that it's somewhat subjective, because if you have a term policy that you locked in a really low rate, you may not need the insurance anymore, Deb. But if it's a nominal cost to keep it, then it's just an extra hedge for you and your family if you can afford it, and it's not really cutting that far into your spending budget. Then you may not need it anymore, but you still could choose to continue it on. Remember, none of us want to utilize life insurance.
No. But it's ultimately it's supposed to be replacement of income, right? So if you're planning on still working for 10 years, it makes sense to do a 10-year policy, right? Because
if you're still needing to work, that means you probably
for other people.
You're still probably saving. You still may have dependents, and the insurance is still nice to have if you can afford it.
Okay, so we're going to take a quick break. And then we're going to talk about what you should do if you have old 401ks with other companies.
Welcome back to Ask an Advisor. Wes Moss, along with Christa D. Biaz.
Yep, we were just talking about last names.
I would say you have a well-known last name.
I do not.
It's a well-known last name. Let's get to this next topic here about the forgotten 401k. And there's a lot of money floating around that's not necessarily lost. And I think that when I first read about this, I was thinking, oh, this is one of these unclaimed asset stories. And it's maybe not as bad as that, but it's a little more sinister than that. And here we are on the eve of also getting new 401k and IRA contribution limit raises. The IRA limit just is going up next year, 2026, to $7,500 a year. The catch up on that is $1,100. The 401k limit, which is also $457 and TSP, that's going up to $24,500. The catch up, so 50 plus, is $8,000. So that's a serious amount in that. So that put them together, you're at 32.5. That's a lot of money to be able to max out 401k. And then there's this special age catch up, which is newer. It's been only the last couple of years. From 60 to 63, the catch up is $11,250.
Wow.
Why don't they just use round numbers? So that max would be $35,750.
Wow.
Now we're talking about serious catch up money. So that's the first part of the story. The second part of the story, how many people really max out the 401k? And that number it's a really low number. And I get that, particularly, and that number will probably continue to go down as these limits go way up. Mm-hmm. There was a lot, in my mind, I think when I first started contributing to a 401k, it was 10. Mm-hmm. It was 10 grand. Today it's 24.5. So it's really gone up dramatically. But the real story, I think we all need to think about.
Well, you're going to say what percentage of people do max out?
Okay, so it's 9% of folks in the 25 to 34 age range. Wow. 9% of America. And then the next age bracket, I think it's 35 to 45. It's something like 12 or 13%. It's a low amount. So let's call it 90% people do not max out their 401ks. And that also makes sense. These are really big numbers. But I don't think the number was all that different 25 years ago when it was 10 grand. Mm-hmm. There's something about saying, well, I don't need to do the maximum. I'm telling you, if you can get anywhere close to doing the maximum and you're putting money in every single paycheck, there's just nothing like that to build. It's a very rarely and good way to build wealth. Just know that these limits keep going up. The other part of this story is that there are billions of dollars now, estimated anywhere from $28 billion to $43 billion, that are sitting in 401k accounts where someone left and the fund or the 401k plan automatically moved it to what they call an old balance. Somebody leaves. They sweep it out of the 401k into something called a safe harbor IRA. And the money gets parked automatically in cash.
Because I remember the advice used to be if you have 5,000 or more, you can keep it in there, right? And so you might be better off with if it's a big company and they have, like a decent, like lower cost and they're with a good provider, that you should keep it. But
well, here's what's happened though, is that just like all of these numbers, they keep inflating. Now it's up to 7,000. Oh. So if an employer now can automatically move a former employee's balance, if it's anywhere between $1,000 and $7,000 into a safe harbor IRA. And what happens with that money, it goes into a money market and people lose track of it.
And so many people, like compared to, 10, 20 years ago, we're switching jobs so much more often now too.
Exactly. So the average American could have a couple of these laying around. And after several years, you've now really lost out on the potential growth if it were to be invested in funds that you could have or probably did have inside of the 401k. Here's the example. Let's say it's $4,500 and it sits in a 2% money market over several, let's call it 4 decades. That $4,500 turns into 10 grand at a 5% rate of return, which is lower than I think people should get over time. You'd be at $33,000. It's 3 times the money just by having the money invested. So the catch here, and this is something for all of us to watch out for, if you've left your employer, it was a smaller balance. So now at that point, smaller means anything 7 grand or below. The 401k plan could have automatically put it into one of these safe harbor plans, and it's sitting there in cash, and it's earning practically nothing. And that's the last thing you want, is to have 3 or 4 of these floating around doing nothing. So take an inventory of your old accounts, consolidate and this is why it does help to have one IRA or one 401k. I like the idea of consolidating everything into your current 401k. So if you've got 2 or 3 old balances, put them in the current 401k, roll them into that. Or if you have one IRA, You don't want a bunch of stragglers around. Put them into one IRA. One, it helps you keep track of it. And two, it allows you to have a better eye on your overall allocation.
Okay, I've got 4 questions I'm going to try to get through here.
Rapid fire.
Patrick in New York. I'm in my 29th year of teaching in New York City. New York City offers a very low-cost retirement, pre-tax retirement account for some civil servants. We have several options for our investments that have done really well over the last 20 to 30 years. I currently have half my money in a diverse stock market account and half in a guaranteed 7% fixed rate retirement account. Yes, it's guaranteed by our state constitution. As I am less
That
than
number again?
7%.
7%.
And he said some people get 8.25%. As I am less than 2 years away from retirement, should I start transferring more money in the 7% fixed fund? I expect to start withdrawing from this account in about 5 years. Additionally, would the 4% rule be too low of a withdrawal rate for those of us lucky enough to have a pension and access to guaranteed 7% fixed rate? Appreciate all of your great advice.
Patrick, yes.
Wow, 7% fixed.
Yes. The 4% rule is too low for you. I don't think I've ever said that before.
Wow.
I've never gotten a question from somebody that has I think it's the tax deferred annuity program, but it is guaranteed by the state of New York. And I've had a few people over the years that have brought this up, and I remember having to look this up because it's an incredibly large percentage that is locked in for you.
Imagine if you have the 8.5% too. That is wild.
Right. I think if you're even higher
8.25.
level, I don't know if it's the superintendents or whoever get this, but yeah, it's over 8%.
Yeah.
Which is an incredible number to be guaranteed. And so, Patrick, right now you're half stock and half in the fixed account. What a balanced portfolio.
Mm-hmm.
What a great balanced portfolio. And you're going to retire in the next, I think, 2 years, and you're going to need it in 5. I would say this. No, the 4% rule does not apply to you. If you even think of it this way, if you have a locked in, and this is just like mathematically, if you have a 7% locked in rate of return, you could take more than the 7. You could take 8%, and hypothetically and mathematically, your balance would only go down by about 1% per year. So you could actually take 8% and be fine and not run out of money because you're gaining 7 every year. You're just reducing it little by little. So you're way beyond the 4% rule. And I think that can be a real blessing.
And that's with half the money, right?
That's with half the money, but I think the question is that as you get closer, do you put more of the money in?
Right, that's what he wants to know. Yeah.
And I would say that it stands to reason that you could be at 75%. And I think part of this depends on your risk tolerance. Yes, the stock side of the market can be more like 12 or 13. It's been more like 15% over the last several years. So it's a real inflation fighter, but so is 7. Mm-hmm. And you can really sleep well at night with that. I would me personally, if I had something like this, I probably would stay at least 50% and do the other 50% in equities because I really believe in stocks over time that are inflation fighters. You could make a case though to go a higher percentage in the 7% number. Now, the one catch I would just say, you make the argument, put 100% in, but you got to be careful about anything that's guaranteed. I don't think there's anything guaranteed in this world financially unless it's backed by the full faith and credit of the United States government treasury. And this is backed by, it might be in the Constitution, but it's also backed by the state of New York.
States go bankrupt.
States go bankrupt. States run giant deficits. That's why municipal bonds issued by states, not all of them do well. Some of them there are counties, there's a lot of examples over the course of the last 50, 75 years where a state wasn't able to pay. So you are relying on the credit worthiness of the state. So I would just be careful of that. One, if this goes wrong, what they would probably do is just reduce that number and then you could take the money out and do something else with it. So I think as long as they're continuing to give you that 7%, you're probably fine. I'd say there's a high level of confidence with that. But just know that there's no such thing as a guarantee from really anything except for the U.S. Treasury. And you're talking about a state. So just be careful with that piece of it. But yes, if you continue with this 7%, you can go way above the 4% rule.
Patty in Arizona says...
the rule of thumb.
Right. Wes, if I've interpreted you correctly...
Who's this?
This is Patti in Arizona. You've said that you like your clients to have about 3 years of dry powder set aside in very safe investments like bond ETFs or money market funds. My husband and I are about 5 years from retirement and want to start setting that up now. Would it make sense to build a 3-year bond ETF ladder analogous to the CD ladder? And she gives an example there.
CD.
Right. And is now a good time to start, or would you wait until we're closer to retirement?
Patti, here's where that rule comes from. There's some math behind it, and it's based on history. We know that on average, and there's been bear markets that have taken longer to come back to where we were before we fell. But on average, bear markets recover, and we get back to where we were, the old high, in about 3.5 years. That's where the 3 years of dry powder comes from, because that should get us through most bear markets. And if we don't want to be aggressively pulling money out if stocks are down 20 or 25 or 30%. So the dry powder is there for that safety net so you can continue your withdrawals and not have to dip into the stock side when stocks are down. And that length of time, 3 years worth of spending, should allow markets to recover. That's where the 3 years comes from. When do you do it? Technically, you don't really need to do it, Patti, until you go from accumulation to distribution. So accumulation phase, we're saving money. We hope it's growing over time. And then you don't really need it until you're in the distribution phase, meaning this is when I'm starting to pull money out. You're only 5 years from that. It wouldn't be crazy to start having dry powder today. From the psychology of money perspective, I think that most people are fine to have 3 years of dry powder, as long as it's not totally interfering with being an equity investor, meaning you don't want every single thing in super safety assets and then miss out on markets over time. But as far as how you're going to do it, I think you have the right idea. You could use one short-term bond ETF as an example, or one treasury money market to do your whole amount you need in dry powder. But I really like your idea of the 3-year ladders. There are a lot of target date, and it's different than a target date fund, but defined to maturity ETFs that they're either corporate or government bonds, and they mature in 26 and 27 and 28. And that would be a really good way to structure essentially building a treasury ladder, but you can use ETFs to do it.
All right. Andrew in Iowa says, I have a question for Wes. What is the benefit of investing in small mid-cap stocks? I understand diversification is good because you never know what company will take off and become the next Apple or Microsoft. But wouldn't the most successful companies end up leaving the small and mid-cap category and become large-cap stocks anyway? If I had put money into a small-cap fund when Apple was there, I wouldn't have missed out on all their gains as they left that category and became a mid and eventually large?
Andrew, you're absolutely right. And we've gone through an environment in the last several years where large-cap companies have really dominated. They've dominated the news cycle. They've dominated the returns. So you start to think, well, wait a minute, why don't I just own large companies? Because the mechanism you described is really how it works. Companies, if they're really successful, they graduate. They'll go from a small cap fund to a mid cap fund to a large cap fund. And you're right, if you only own small caps, you would have owned Apple for a little while, but eventually it graduated and became a mid cap and then eventually graduated to a large cap. So you're right, you would miss out on the continued growth as some of these companies have gotten bigger and continued to have a really phenomenal pace of growth. So the answer here is you do want to own all three. And it makes sense to me to certainly have large cap, but mid and small as well. And technically, most of the time, I think of Russell as one of the index providers, and they have ETFs. But they are, once a year, they take a snapshot of the size of the companies, the market capitalization, And if it's grown from a mid to a small cap company, then it'll go into their large cap ETF. So you're right, they graduate, and that's why you don't want to have just one of those three categories. I think it makes sense to either have both small and large, or all three, small, mid, and large.
All right, and here's one more. Gary in Florida. In his book, You Can Retire Younger Than You Think. I
love that. That's a good title, Gary.
Wes says that the happiest retirees own a home valued at $350,000. Given inflation, what home value would Wes say is equivalent for retirees today? And it's sooner than you think is the real title.
I like younger.
Yeah.
You can retire younger than you think.
Same thing, right?
Love that. I love that. That's an old book, Gary. That's old. Mm-hmm. And we've had a lot of inflation since then. And that's the reason.
You have a new one coming out next year.
I did. I finished writing the Retire Sooner method, so that'll be coming out in 2026. But the data in the book, You Can Retire Sooner Than You Think, was all the way back in 2013, published in 2014. Those are old numbers, and you're right, we've had a lot of inflation. From 2014 till today, if you were to look at the Case-Shiller Home Price Index, it's up about 100%. It's a little more than 100%. So if you were just to adjust for inflation, well, actually, housing inflation, you'd have to double that. So a $350,000 house in 2014 would probably be worth $700K today. The real key here, Gary, is to have your mortgage pay off with Insight or mortgage paid off. That's one of the habits of happy retirees. You get rid of that big number you're paying to your bank or your mortgage company. That's really the key. It's not as important on the value. It's about getting rid of the mortgage to be a happy retiree.
All right. Well, that's going to do it for us for today in this week's episode of Ask an Advisor. Thank you for all your questions. Please share this with a friend, and please review us on Apple Podcasts or wherever you listen. We really, truly appreciate it, and it helps us to grow our audience and share Wes and Clark's knowledge with more people. Have a wonderful rest of your day.